Hi everyone, this is Finance Ministry Real Estate. We meet here every Tuesday, 6:30 p.m. Eastern Standard Time. We are a YouTube channel as well. Do check us out on YouTube, Finance Ministry Real Estate on YouTube. We have amazing guests here every week. So today we have Tariq Sattar from Anthem Capital. So he's going to talk about today's real estate market. It's a very interesting topic for most of us, most investors. So he's going to discuss opportunities present in the market as well as provide his own outlook. So Tariq is the co-founder and CEO of Anthem Capital. He previously worked in management consulting and corporate restructuring for Deloitte and Alvarez and Marshall. He has owned over 10,000 multifamily units and once owned 55 single-family properties as well before selling all of them. His expertise is at every stage of Anthem's project lifecycle, selection, acquisition, development, and disposition of properties. So a lot of amazing experience to share with us here today. And yeah, if you guys do have any questions, feel free to put them on the chat, or we're gonna have like 20-25 minutes lecture, and then we're gonna open up for questions, like more open format Q&A after this. So with that, I'm going to pass it on to Tariq. Again, Tariq, pleasure to have you here. And yeah, if you guys gonna have any questions, do put them on the chat. Thank you.
Thank you, Stefan. Happy to be here. Thanks for having me. Just a quick background on Anthem Capital. My business partner, co-founder Ivan Bayan, and myself founded this in 2016. Both of us were in the single family space prior to that for a number of years, and had between the two of us almost 80 single family homes in Oklahoma and in Texas. We have been growing at a pretty fast clip, but we're not moving fast enough. At one point, I was buying a home every 10 days or so, and even that was not enough of a pace to get to where I wanted to get to. So just looking at the opportunities for scalability and to move up the ladder quickly, started looking at commercial opportunities and looked at all the various commercial spaces, and ended up narrowing it down to the multifamily space. Apartments, classic workforce housing is what we focused in on. So over the last several years, we have syndicated, purchased close to 3,000 units across several different states. There are more than a dozen of these acquisitions that have now gone full cycle, and we have sold. We had at 1.6 assets here in the state of Oklahoma, which is where I am personally located. All 6 of those are sold. We had the 2 assets in Arkansas. Those are sold as well. Our current holdings are several in the Dallas-Fort Worth market. Then we have assets in Arizona, in Florida, in Salt Lake City, Utah, and more recently, we have 2 assets in Kansas City as well. So that is just a quick background on Anthem Capital. The market has been very strong in recent years, and going into any one of these acquisitions, our typical hold period projection is about 5 years, but we have held most of our assets between 3 and 4 years. And we have averaged, high 20s, 27, 28% annualized rate of return across the portfolio for the 12, 13 exits that we have had so far. So with that background, I'm just going to jump into where today the market, the real estate market, where it stands today, and what the outlook is. We have been going through quite a bit of turmoil in the capital markets, in the interest rate markets in the recent months, starting with just because of the inflation, and as a result, Federal Reserve finally stepping in. Initially, they had a view that it is transient inflation, which will just pass through. So they were a little late in acting on that, and inflation seems to be taking hold and continuing to go up. So once Federal Reserve decided to act, they have acted quite aggressively and have multiple interest rate increases that we have experienced in recent months. So as a result of all of those interest rate increases, we are looking at the 30-year mortgage, which is the most common mortgage product for single family home ownership. Those rates are, they were getting up close to 7%, but they are now, as of today, I was looking at the latest rates and the projections are at 7.1, 7.2%. So they are continuing the uptick at a pretty fast clip. As a result, the loan that just because of as a result, the increase in the mortgage payment results in the amount of loan that can be taken out to be lower. So the loan sizing comes down. The market is cooling off in the single family space, but if you look at this graph, the market listings, if you look at these historically going back 22 years, going back to 2000, you see that we peaked around 2007, 8, 9 timeframe and have consistently been coming down since and have been at the lowest point in terms of the listings of single family homes. But it has started to tick up slightly. You see a lot of press about single family home sales going down very rapidly. But as you look at this chart, you very clearly see that the uptake is still very little, and we are very far below the long-term average over the last 22 years or so. And as a result of these, the inflation, the interest rates going up, the housing affordability, one of the key things that we look at in the multifamily space is affordability gap. And that is the graph at the bottom here that you see, where it's very clear that the difference, the delta between an average rent for an apartment and the mortgage payment of a single family home is by far the widest margin that we have historically had. It has crossed the $1,000 mark recently. So over $1,000 delta, it used to be, a few $100s, but it continues to go up. And the graph that you see on top is just looking at the annual income that you need to have for an average household, for a median house size household, median priced household in the country. So that has pushed up beyond 100,000, beyond 6 figures. So closing up on 125,000 has been, has been going up quite consistently for more than a decade. So that, with that delta between single family mortgage payment and multifamily or an apartment rent monthly payment, that delta having gotten to over $1,000 just increases the affordability gap, and it just increases the appeal of the multifamily space that we have been focused on for the last several years. The other thing that, a couple of other things along with that, when you look at the population dynamics within the US and you look at on the top chart, the orange bars in the middle, which is the millennial cohort aged between 26 and 41. And that is typically the time when you are looking to buy a home. But when you look at the median household income and the affordability gap, that delta is so big that the renters typically in their 20s, late teen years, early 20s, are not going to be able to own a home, buy a home, and move into a single family home. So that just leads to a pretty strong tailwinds for the rental space in the multifamily space. The other thing to look at is there are always new developments going on in all the various markets across the country. But when you look at historical data of both in the single family and apartment space, and you look at this graph with where the apartment vacancy is currently, it becomes very clear that the builders have not been building at a pace to meet the demand of the growth, the demand that is there with the population growth, with the demographics that are there. So as you can see, going back to 10, 12 years ago, 2008-9 timeframe again, where that vacancy rate in the apartment space had gone up closer to 8-9%, has consistently come down. And as you can see, it's now close to 3-4%. And it's quite common now in today's market that you have properties that are rented at 98 to 100%. And the rents have been going up quite steadily in recent months and quarters. We have experienced some very strong rent growth across our portfolio in the various markets that we are in. Our most recent acquisitions that we have closed on have been 2 in Kansas City and 1 in Salt Lake City. And across all 3 of those assets, what we are experiencing is that we had certain assumptions on where we would expect to be able to grow the rents after we have made the capital expenditure and made the capital investment and rehabbed and improved the apartments and the units. But what we're experiencing is that we are able to get very close to those rent numbers even without having to renovate and upgrade the apartments. It just goes to the strong demand. We have experienced double-digit rent growth. It is starting to slow down, and that is double-digit that I mentioned is year-over-year rent growth in the apartment assets that we own. But that pace of growth is starting to slow down, and it has to slow down because wages are not growing at the same pace for the renters to be able to afford to pay those rents. So the rent growth has to slow down, but it still is going to continue to go up. Just wanted to focus on these are the growths that have been experienced year over year in the various top markets across the country. We are in several of these markets, and Orlando, we own the very top one on the left. We own an asset there. We actually are in the process of selling that asset. We have owned it for maybe under 3 years at this point, but with the strength in the market, we decided to take it to market and have it under contract to be sold hopefully in the next couple of months. Other than Orlando, Dallas, Tampa, those are very good markets. Charlotte, then Austin. Denver is a very good market, has been growing at a very strong clip, as is Las Vegas. Phoenix has proven to be very good. Kansas City is on that list. Houston is on that list. So those are, some of the markets that I've just named. Those are the markets that we are very focused on ourselves. Atlanta is in there as well. Went back to search for it because that is a market that we have been very focused on as well. So, the bottom line is that despite all the headwinds and the increases in the interest rate, which has had an impact on the loan sizing in this sector as well, the transactions are continuing to happen. We have closed on 2 assets this year. We are in the process on a 3rd one currently in the Dallas-Fort Worth market. We have sold 2 assets this year already, and we are in the process of selling 2 more. So transactions are continuing. The loan sizing has come down. The pricing has adjusted somewhat, but the outlook on the growth in this sector is so strong, and there is so much liquidity that is being pushed into this space that the interest continues to be very strong. Not as strong as it was, last year. The number of the buyer pool has definitely shrunk, but I think just based on the most recent experience that we have had with a couple of the listings that we're in the process of selling right now, although the buyer pool has shrunk, but I think the quality of the buyer pool, the continuing players in that market are very strong. There is also, the lending market has been impacted as well in this space. There are a lot of bridge lenders that have pulled back. The leverage has come down. Agencies, the Fannie and Freddie Mac loans have come down in leverage. The bridge loans have come down in leverage. On the equity side, the investors, with the drop in the stock market, the investors are skittish as well. Some of the private equity groups that we have partnered with over the years to acquire some of our assets, they have pulled back as well. They have become more strict, more stringent in their assessment, in their evaluation of the deals that they invest in. Some of the private equity groups that were investing as a GP or as a partner are now choosing to invest only as a preferred equity investor. So landscape continues to change, but the market continues to be very, very strong. And so that is just, an overview of market from where I see it, with the experience in the single family space, as well as now for a number of years in the multifamily space. And then just wanted to end with that, there's that QR code that we have there. There's a book that we came out with earlier this year, just a short, quick guide on the opportunity to unlock your wealth potential through real estate investments, which is, our mantra, which is what we focus on. This is a quick read, takes about an hour. It's for sale on Amazon, but you can scan the QR code and get it for free. Just in a nutshell, going into the specifics of why is it so much easier to start with a smaller amount of capital and have the ability to grow that if you have a medium to longer term perspective in mind, and invest that money in real estate and grow that. We have experienced that ourselves. We have plenty of investors that continue to invest with us on an ongoing basis, that are experiencing this on a day-to-day basis. So just wanted to make sure that we have the opportunity to make this available to anyone that may have an interest. Stefan, back to you. That was my view on the market, and happy to take any questions or if anything in particular that you wanted me to get into a bit more detail.
Great. Yeah. Thanks, Tariq, and yeah, great presentation. So just a little bit about your book. So Unlock Your Wealth Potential Through Real Estate Investing. So what do you talk about there that some of our listeners and viewers can learn from basically in your book?
Right. So it just picks up some of the key ingredients, key data points that we have focused on and we have learned along the way. I had no experience with real estate investments, maybe 10 or so years ago. And I was forced into it by my wife, who wanted me to explore this as an opportunity instead of continuing to put money in the stock market. So, but once I started down the path, it became very clear. I did a lot of research before I started down the path, and it became very clear that there's a lot of misinformation out there, a lot of fear of the unknown, of if something that you have not experienced and done yourself. You just tend to talk to others and take input from others and discuss. And you got to look at who is it that you are talking to, who you are getting guidance from, how much experience might they have in the space that you are looking to explore, to get into. So I chose to go and talk to people that had portfolios of hundreds, at least 100, if not several hundred homes in their portfolio, and had been in that space for a number of years, and picked their brains. Spent months, over a year, researching and reading before starting down the path of single family investing, and then realized just a couple of years into it that even though I was buying a house every 10 days, it still wasn't going fast enough. So scaling up, went back to the drawing board and again research and talk to people that had been in commercial real estate space for decades and had done extremely well in it, and just pick their brains on how to go about it, things to do, not to do, how to avoid the pitfalls, how to not have to reinvent the wheel, and found that people are very willing, ready, willing, able to share their experiences and guide and hold your hand. So this is just picking some of those key data points from those experiences and putting that in about an hour and a half of reading.
Mm-hmm. And so that was, which year was it, or like which years when you were doing still single family investing and you had like those 55 single family?
Right. So single family, I started back in 2013. So 13, 14, 15, I was, really in 14 and 15 were the 2 years that I was really in the acquisition mode and buying a lot of single family homes. And then switched over into multifamily space in late 15, early 16. Held on to the single family portfolio for about 2 years. Was not sure how the multifamily space was going to pan out. And so waited about 2 years before making the decision to dispose of all of that. So sold those off in a couple of years, started selling those in late 17, early 18, and was sold the last one just a couple of weeks before COVID hit in early 2020. But I had, I had gotten into the multifamily space in late 15 already, and had started investing initially as a passive investor in early 16, and then we had acquired as sponsors, as lead sponsors, as GPs, 4 assets in 2016 in Oklahoma.
And when you so in your profile, so where you say like the 10,000 multifamily units, so is that general partner as well as limited partner investments, or?
Right. So 10,000 is just as a limited partner. We have about 3,000 as a general partner on top of the 10,000. So about 13, 14,000 in total. Right.
Which the 3,000 as a general partner is it's a significant number, right? In that sense.
Absolutely.
That's a lot of experience.
Right. So and as part of those acquisitions, we have I think the acquisition value would be about 250 million for those, and we have raised equity of about 80 million for those acquisitions, and a lot of that equity for the first several years was just raised from individual retail investors with a $50,000 to $100,000 minimum. But as we took some of these assets full cycle and had a good track record with several of them, then we started getting good traction with private equity groups and other equity sources. And then we have done now several acquisitions where we have equity, at least half of the equity coming from a private equity group.
Yeah, that's a great transition in that sense. And so you mentioned with regards to like the gap, I guess you can call it for the relative affordability of apartment renting versus owning, kind of affordability gap And it's like one argument to multifamily. Like, are you seeing what other aspects of multifamily you find make it relatively resilient in the current, let's say, point in the market cycle? What is your view on?
Right. So in the current market cycle, the space that we have been, so within the multifamily space, you have, different classes of the apartments. You have A, B, C, and D, right? So the newer, of course, new development, relatively newer product would be the A-class product. We have typically been focused on classic workforce housing, which would be in a C, C plus to a B, B minus category, which are typically, 20, 30, 40 year, sometimes 40 years old assets. These are assets that, when we look for those that have a value add potential, and it has over the years, as we have, this cycle has gone on for a while, it has become more and more challenging to find the true value add opportunities, but they do exist. The most recent acquisition that we closed on in Kansas City is an acquisition that the current owner had held it for 35 years. So it is the first transaction on that asset since it was built. The exterior of the asset is in excellent shape. The interiors are classic 30, 35-year-old interiors. So we have a great opportunity to upgrade the interiors. It sits in a good high income, median household income, 70,000+ median household income area. So that sector of the multifamily space, because as economy slows down, and if we get into a recession and the growth slows down, what typically happens is that you have people stepping down from A to a B to a C, and then you have concessions that you may need to offer, rent concessions. You may have to have specials as your occupancy may get impacted. So those are real things that could happen as we go through this cycle, if we really get into a downturn and recession comes in. But if you look at the historical data, the drop in rents or the concessions in the C to B space has been the least compared to the other categories in the multifamily space.
Mm-hmm. So would you think C or B could be the most resilient?
Right. That definitely is what the historical data tells us, and that is the expected outlook as well.
But with an advantage to B, I guess, or what do you think in that sense?
Probably, C to B, that space, and it's not always easy to identify which category you put into. A broker is always going to put it into a higher category, but you in having done this now for a number of years in so many different markets, you can take a drive around the area and get a feel for the demographic, the kind of retail that is there, the kind of housing that is there. And that will really tell you whether it is a B or a C asset or a B or a C neighborhood. And B, I would say the B minus space would probably be better than a C kind of a space, as if the downturn continues, recession, unemployment, because of those factors.
Okay. And in terms of, I guess, let's open up if you guys the floor to others. Like, if you guys have any questions, do you wanna speak up? I do have more questions myself, but I want to make sure I'm not holding others off. Okay, kind of quiet today, right? Okay, so I mean, you mentioned Kansas City, like, so you guys, I've noticed like a recent uptick in activity seems to be in Kansas City. Is that something that you have found? Like, did you guys more recently move there from some of those other more booming markets, or have you been there for a longer time?
Well, we have looked at that market for probably 3 years. Have taken multiple trips there. We pursued 2 or 3 different opportunities in the last 3 years there, but were not successful in any of those. We were, what we have typically, excuse me, tried to do is to have someone on the ground, boots on the ground, a local partner, co-GP, co-sponsor with us in any market that we are in. So we have co-GPs, a couple that is local to the Kansas City market. They have been in the single family space, commercial space for a while. But we teamed up with them last year and really focused in on that market, met with several of the brokers, key brokers in that market, and ended up pursuing a deal late last year that we ended up getting under contract and closed on earlier this year. And that was, as sometimes you find an out of state, this was a California owner that had purchased it and held on to it for 4 or 5 years. In-house management, no third-party management, in-house management. The leasing agent lived on site, limited amenities, limited to no amenities, and there was just a significant opportunity. The property was not well taken care of, so we were able to get that under contract. So that was the entry in that market. And once we had that one asset, there was this second asset that we knew was coming to market from a brokerage that we have a very good relationship with in various markets and have transacted with them in multiple markets. So we had an early look at the asset, and we wanted to see if the seller would entertain a preemptive offer, but the seller wanted to take it through the whole marketing process. So we went through that competitive process, went through multiple rounds of offers, multiple rounds of best and final offers, and finally were able to get it. And this is one that we just closed on a couple of months ago. And in the middle of all this interest rate movement and volatility, we were able to work with a local bank in Kansas City that it's a partial recourse loan that we put in place, fixed rate, 4.99% for 5 years with 3 years of interest only, with step down 3%, 2%, 1% prepay in the first 3 years, and no prepay penalty after that. So that is an excellent financing, very good leverage that we were able to get on that loan, on that acquisition. So that that market, we as I said earlier, we have been focused on for a number of years. We just really honed in on it about a year ago, and as a result have 2 assets there. First one is I think 160 units, and the second one is 253 units.
Mm-hmm. So question we get on the chat actually, are you guys raising money for any specific deals currently? Like IR Cass is asking, do you guys have any opportunities right now, or? Right.
So there is one acquisition which is towards the end of its capital raise phase. It is in Dallas Fort Worth DFW market. We already have at one point we had 6 assets in that market. We have sold 3 of those, and so this is going to be our 7th acquisition in that market. It is early 1980s asset, 174 units, about a $24 million purchase price. We, I think, have maybe another $1.5 million of equity left to raise on that, out of a total equity raise of about $9 million.
Mm-hmm. So that's in DFW market.
Right, that is in DFW market. That is, I think the median household income in that area where this property sits is 63,000. A couple of the other factors that we always look at, retail in the area is good high-end retail. There is the schools in the area are good high-rated schools. So those are some of the key things, other key things that we look at as we are looking at any acquisition opportunity. This is a property where the seller, they are an institutional seller, very well known to us, Madeira Residential. This property, they have done a lot of the heavy lift on the exterior of the property. So the property presents very well. The exterior has been painted, the balconies, the fences have been redone. The interiors are older. So some of the things that we plan to do, we are going to replace the roofs of the property. You're going to replace some of the other mechanicals that need to be upgraded, but the units are going to be upgraded. We are going to enhance the amenities, add a dog park and play area for kids. There is unutilized space towards the back of the property that just sits empty and has actually been fenced out of the fenced in area. So it is owned by the properties. We are going to fence that in and put in a play structure and for kids and a dog park in that area as well. So that Arriva Apartments is the name of the property. And I think if you go to our website at anthemcp.com, you should be able to get some more information on that, or you can just scan this QR code, send us an email, and we can come back to you with some more detail on that opportunity as well.
Right. And so you guys, clearly have been able to complete like a wall of acquisitions, right, over the past 6 years or so in the multifamily space. So what has been your approach to finding deals now? You mentioned, let's say, last one being an institutional seller. Is it kind of having really, and you seem to be pretty much invested in like very primary markets, right? Like DFW, like Tampa and so forth. So what has been your approach to find deals in those competitive primary markets, I would say?
Right. So the market is and has been very, very competitive. There rarely ever is an off-market deal, no matter what the broker might tell you. No pocket listings really. If you are getting it from a broker, probably at least a half a dozen other people are getting it as well. And then the sellers, and we have been, sellers in this market as well. We have sold, more than a dozen assets in over the years, and we would want to take it through the marketing process as well. Going into it, we would have a number in mind. When we are selling, we would have a number in mind. And a more recent transaction that we closed on in the DFW market that we sold, we had a BOV, a broker's opinion, a value of about 18.5 million. And there was a 1031 buyer that toured the asset, loved it. On the third day of the listing, made us an offer of 19.5 million with $1 million non-refundable earnest money. We signed the contract. So, and it is closed, it is sold. But on the acquisition side, this is a relationship business. At the end of the day, your relationships, your reputation matters. The fact that we had previously transacted with Northmark in DFW market on the buy side and on the sell side helped us tremendously in Kansas City in our first acquisition there, because that was the listing by the same company, by Northmark. So the brokers in Kansas spoke with the brokers in Dallas, had a comfort level, and pushed us to the list with the seller, and we were able to get that. So it is a relationship business at the end of the day, and your reputation. Do what you say you are going to do. There are plenty of advice out there about putting a property under contract and going back and then retrading it. unless there are valid reasons for you to go back and ask for that adjustment, price adjustment, or retrade, don't do it. There have been multiple on the buy and sell side both, where we have gone back to the sellers, or the buyers have come to us asking for adjustments for things that they had not accounted for, things that had changed since the initial agreement on the price had happened. So if there are valid reasons, absolutely, but don't do it unless there is a valid reason. And that track record will give you, no matter where you go. It is a very small space, and your reputation precedes you. We, of the deals that we have purchased, there is one that I can say we were able to buy off market. This was before it was listed. It was an acquisition of a 210 unit property in Arkansas, where the property management company that was managing our asset in Oklahoma City at the time had a relationship with the seller, who was thinking of selling, had a number in mind. They came asking us, the property management, the CEO of the property management company called me asking if we would be interested. We underwrote. We went back to them at that price point, and we had it under contract very quickly. This was a property that we sold maybe 3 years later, and it was sold maybe about 18 months ago. So that is probably one that I can say we might have gotten off market before it was really marketed to a broader group. But any property that you're pursuing today is most likely a property that is being marketed out there, and you want to make sure that you have good relationship with the brokers, with the lenders that you're working with, to make sure that you're able to bring the required finance to the table, and then are able to bring the equity to the table as well.
So relationships with brokers, lenders, in some case, property management companies that could bring you the deal as well, in some scenario, kind of one-off, but still.
Yes.
So other than that, do you guys have any like more off-market direct owner process, or you would say at this asset size, it's not so productive to do so?
No, we have never done any kind of a campaign directly to the owners.
Mm-hmm.
We as owners do get letters in the mail at times, do get calls at times. Rarely do we entertain those. I don't think we entertain them. No, we don't do any of these direct campaigns to reach out to the owners directly. We at properties that are typically more than 70, 80, or most of the time more than 100 apartments. So in that space, there are larger owners, larger ownership groups. So typically they would be going through a formal, they would have private operating agreements, and they will want to go through a formal process to make sure that they're able to bring in the most value and maximize the returns to their investor pool.
Mm-hmm. And on the capital raising side, now you mentioned switching, built your experience, so extensively, right? And then you were able to kind of tap into some like private equity, or is it perhaps family offices capital? But until that point, what was your approach to capital raising? Now, I know like some people have different success with social media, or be it their podcast or their website, search engine optimization, and so forth. So what was most beneficial to you in that direction?
Right. So a vast majority of our earlier acquisitions for the first, I would say, 3-4 years were primarily 506B offerings, which were investors that we had a pre-existing relationship with, that were, that we had interacted with on more than one occasion previously, that, we had that are part of our, ongoing campaigns and part of our database. So those would be mostly the individuals that were investing with us for the initial several years. We have had some 506c offerings as well, which, we have the opportunity to market those on social media, on LinkedIn, on Facebook, any other kind of media. And we have done those as well. And, depending on what is the minimum that you put your investment amount at, you may or may not have success with that. We have had sort of a mixed response. We continue to do, depending on the size of the capital raise, we may do a 506B or a 506C, but there is now, you also have the opportunity to start out with a 506B and take and market that opportunity to your Rolodex, to your investor database initially, raise what you can from there, close that off, and then transition the same offering to a 506C. So that is something that we have done more recently as well.
Got it. And so now you still mentioned like some of the Tampa and DFW and like some of, again, like I don't know if it's the right classification primary markets, right? Because there's like quite a few different classifications on that, and like some of the more traditional like New York and Chicago perhaps are primary and so forth, but like pretty competitive markets on the growth side also in multifamily. But so what is your view ahead in terms of if we do enter a recession or don't enter a recession and so forth? Are you bullish yourself on multifamily? Are you making any changes to how you guys underwrite or which markets you guys invest in?
Right. So as this cycle has gone on, we have chosen to focus more on the primary markets instead of secondary or tertiary markets. Mm-hmm. Now, you mentioned markets like New York, Chicago, or markets in California. Yes, they are primary markets, but some of the key criteria that we look at, one of the key ones is landlord-friendly legislation, where we are able to, if there's a non-paying tenant, we are able to evict tenant in a timely manner and not be stuck with a non-paying tenant for an extended period of time. So that is something that goes against some of those, New York, Chicago, or California markets. Yeah. The other is population growth, employment growth, and we are very focused on markets where there has been consistent population and employment growth, and if there has been a population growth, there have to be underlying fundamental economic factors fueling that growth for us to really focus in on that market. So those are, a couple of the key criteria that we look at. And once we start looking at, if you look at this previous slide here, if you look at all the markets that are there, I'll just start from the left, the markets that we focus on: Orlando, Nashville, Dallas, Tampa, Austin, Atlanta. Las Vegas is great. I've tried, but have never been able to get anything there. Denver, very expensive, but great market. Phoenix, Kansas City, Houston. So those, are the markets that when I look at this graph, those are the markets that out of those that we look at. And out of those, at any given time, we are focused primarily in 3 or 4 markets, not more than that. We don't want to stretch ourselves too thin. We want to make sure we have, good footprint there. We have relationships with property management companies, with vendors that we are working with in those markets. And those are very key in long-term success in any market that you're going to be playing in.
Mm-hmm. But some of the markets you mentioned, so they're the ones that had like extremely high rent growth, kind of boosting huge kind of profit margins for multifamily investors recently. And I've seen like personally on LinkedIn, like a lot of like very high IRRs on projects in those markets, partly due to the very big rent growth. And that fuels cap rate compression further, right? Because rent growth or net operating income growth rather, is a component of cap rates, even in the theory of those, right? And so what is your view of some of those markets? And we've already seen some of the rent growth kind of coming down, right? But what is your view in terms of if extremely high rent growth in some of those markets may have driven cap rates a bit too compressed, and that may kind of decompress, but perhaps in the future, like what would be your thoughts on that?
Right. So the cap rate decompression is currently ongoing, right? Because of the leverage having come down because of agencies now, in the mid 50s to low 60s percentage leverage. Bridge lenders at one point were, high 70s, 80 plus. They are in the 60s as well. It is tough to, and a lot of bridge lenders have actually pulled out of the market. So, and that's, where going into with the outlook on the interest rates being so uncertain and so much volatility in that space, the, outlook on where your floating rate loan interest might be, the interest rate caps are so expensive to buy right now. So it just complicates, and people are very focused now on, people are preferring to have financing by way of fixed rate loan products. So with that, it is low leverage. So the pricing has come down, pricing has adjusted. There is no doubt about it. Has it adjusted enough? Probably not yet, but it continues to adjust. There are plenty of listings where, the broker would start out with a certain price point up there, and a couple of weeks later, it would be revised lower. And then a couple of weeks later, we got a call that just put an offer in wherever you think it works. So that, that adjustment is going on purely by way of the interest rates increasing, by way of the loan sizing coming down, by way of the leverage coming down. That has to adjust. So cap rates are decompressing, are starting to go up. How far up are they going to go?
Tariq, just a question on that, because it just sorry to interrupt on the loan sizing coming down. So have you seen that more from the perspective of just debt service coverage ratio, just because, okay, it's hard to meet with current interest rates, that requirement? Or are you seeing separately, even if for a deal that cash flows enough, lenders are still now adjusting some of the loan sizing, or they're only adjusting it due to the cash flow not covering otherwise and so forth?
Right. It's primarily driven by the debt cover and debt or debt yield, depending on who the lender is and what criteria, what hurdle they are utilizing. But it would typically be a function of either debt cover or debt yield.
Got it. Okay, so we're right on the mark now for our 1 hour. So what is the best way for people to reach to it? It was a, I think, very informative lecture. I appreciate putting the time and education forward for us here. So yeah, the best way to reach to you once again.
It's the best thing would be to just scan. You can send us an email, and we can come back to you on that. My personal email, my business email, my first name, Tariq, Tariq at Anthem CP, short for Anthem Capital Partners, anthemcp.com. So that would be the easiest way. I, make myself available to people that have an interest in this space on an ongoing basis. I started out this way. I reached out and was able to get an audience get some time with people that had a lot of experience in this space. And I'm always very willing to make myself available to anyone that has questions. Nothing that we have been able to do in this space, there's no secret about it. There is nothing proprietary about it. If I can do it, others can do it better. So I'm very ready, willing, able to share my experiences, answer any questions that people might have.
Great. Awesome. Thank you so much.
Thank
And
you.
thanks to everyone for joining.
Bye
Have a
now.
good day.